Good afternoon, everyone. Welcome to another installment of our monthly webinar series. My name is Catherine Baxter. I'm going to be your moderator for today's session in conjunction with Diane Rector. But before we get started, I'm going to give you a few administrative announcements so that you can benefit most from our webcast. Please adjust the volume on your computer and the webinar console so that you can hear the webcast. If you have any trouble viewing a slide, you may resize the window by dragging the bottom right corner of the screen. Please allow pop-ups from this website. Set your screen resolution to 1024 by 768 or higher so that you can see the slides appropriately. At any time, you may submit a question using the Ask a Question feature to the left of your console or at the bottom folder that looks like a question mark. You can download these webinar slides by clicking on the green arrow also at the bottom and center of your screen. We will issue a survey because we do want to get your opinion of this particular webcast. So stay on the line. We'll push that out to you right after we're done with the Q&A. And as always, our webinars are closed captioned for further viewing at a later date. Also, I wanted to describe some of the widgets that you'll see at the bottom of your screen. Again, in order to download the PowerPoint, you'll see a green widget that looks like a folder. If you click on that, you should be able to download this presentation. And also, there are other items that will be in the blue folder right next to that you will want to download in conjunction with the presentation. As I mentioned earlier, this is a series of monthly webcasts. Today, we're going to talk about small dollar loan programs. And our lead speaker today is Tom Penna. And Tom is going to introduce the rest of his cast today. And then as we go further into the webcast, Diane Rector will take the comm. She is our training manager for the Office of Small Credit Union Initiatives. So without further delay, I'm going to turn the console over to Tom Penna.
Thank you, Catherine. I'd like to introduce you to the participants of today's webinar. We have Cindy Johnson from the Office of Examination and Insurance, Carrie Donald, a Region 3 NCUA examiner, Katia Nunez, she's the CEO of St. Francis Federal Credit Union, Jennifer Lovett, the CEO of Mississippi DHS Federal Credit Union, and Vicki Hastings, CEO of Greenwood Municipal Federal Credit Union. The objectives of today is to discuss small dollar lending loan programs and their regulations, and hear from basically is to have you consider offering an alternative loan program compared to payday lending and title loan companies is right for your members. We will discuss the difference between the payday loans and NCUA's payday loan alternative. We will discuss the regulations affecting these programs and hear from the three credit union managers outlining their programs for you and the benefits they receive as well as the members. You may hear us refer to the Payday Alternative Loans Program that NCUA offers, and the short-term small amount loan program called an STS interchangeably throughout the presentation. The webinar is for all credit unions, state and federal. Some of the presentation addressing parts of the NCUA Payday Lending Alternative programs may only be applicable to federal credit unions because of interest rate limitations. Otherwise, you will find the webinar content can help all credit unions save their members money while finding another way to increase your bottom line. Before we begin, let's find out who's on the call today. Will you please complete the first poll question is, what is your credit union's asset size? And we'll give you a few seconds to do that. Okay. And the results are, nope, not yet, okay. And the results are, the majority are from the $10 to $50 million category with 34% coming from credit unions over 50. And about 4% are credit unions less than $1 million. That's a pretty good distribution. Who grants small dollar loans? While banks and credit unions may offer small dollar loans, we are not the big players. The retail operation specializes in payday loans are. They benefit from offering convenient services even though they charge very high fees for the funds borrowed. Borrowers take the small dollar loans out for several reasons. First, it's because they are quick and easy to get. If you have a job, you can qualify for the loan. Other reasons are they help pay for expenses that are unexpected. They offset cash flow shortfalls when a bill comes due before the income comes in. Sometimes a borrower's bills are more than what their income is currently. Some borrowers even use them for small plan purchases, while others look at it as a cheaper way to borrow than paying an overdraft fee on a checking account or a late fee on a credit card payment. Unfortunately, this is where the problem lies. They generally cannot come up with a full payment when due, so the loans must then be rolled over into subsequent loans and more fees incurred. What is a payday loan? Okay, a payday loan is a $40 billion industry making small balance, short-term unsecured loans. Based on our information from our December call report, I found there's 453 credit unions reporting 59,000 loans with a total balance of outstanding of $21.5 million. Thus, you can see there's a lot of opportunities for credit unions to make more loans to members if it's a $40 billion industry and we're only making $21 million. The payday lender makes applying for a loan very simple. The applicants generally complete a simple application, provide a pay stub as proof of income, and give the retailer a post-dated check or a pre-authorized debit to their account for the loan payment. The loans requested are small, generally averaging between $350 and $500. The terms for loans have maturity limits of 30 days or less, with an average around 14 days. The lender expects repayment from the borrower's next paycheck or another source of income. Ordinarily, lenders do not advertise an actual interest rate, but they charge a fee schedule based on the amount borrowed. However, some lenders also charge the interest rate as well, so it's different in every state you look at. The fees are considered a finance charge and are converted to an annual percentage rate to comply with truth in lending regulations. The fees charged generally range from $10 to $20 per $100. But in some cases, they can be much more than that. When you convert the APR for these fees, the loans can be the rates can be in excess of 300% and could be as much as more than 1,200% interest. Borrowers are one of the advantages the borrowers look at is they rarely look at the annual percentage rate charge. What they look at is what's the dollar amount going to cost them. A $300 loan will generally cost $45. The borrower needs the money and is willing to get it at any cost. Some of the regulatory concerns that we looked at within these programs are truth in lending compliance, high APRs charged to the borrowers, and that sometimes the loans are considered as predatory lending based on the typical borrowers using the programs. As a result of the volume of payday loans being written and many of the excessive interest rates and fees charged, regulatory agencies are starting to take a careful approach to regulating and controlling payday lending. Several states have prohibited payday lending, but the internet providers are finding their ways into these states. If you are a state charter, we also want you to please check with your state regulator for any specific regulations affecting your credit unions. The military became very concerned with this as well. They saw that a number of payday lenders were opening business right outside the gates of the military facilities, and the members were getting caught up into a constant rollover of the debt. As they couldn't make the payments, they would be rolled over into the next loan. As a result, the Department of Defense enacted a number of regulations that restricted small dollar terms for its military members and their family members. The statute, they adopted protections limited to 3 different types of loans that have maturities of less than 91 days. They include the payday loans, the vehicle title loans, and tax refund anticipation loans. Just quickly give you some of the restrictions that the military has imposed, which include a 36% APR interest rate cap. They prevent rollovers when the loans come due. In other words, the institution cannot just keep rolling over and charging additional fees. They prevent the use of post-dated checks and ACH debits, as well as requiring members to provide a military allotment for the payment. And further, they also prevent any prepayment penalties to the military personnel. Soon after the military made some changes, NCUA followed. The changes were in part due to how some credit unions developed the original payday lending programs or alternative payday lending programs. The original changes or developed programs produced some unintended exceptions because they exceeded the NCUA statutory 18% limit. The violations occurred because the programs initiated an additional fee for the program that were not included in the APR. As a result, the NCUA board in 2010 issued a new program called Short-Term Small Amount Loans, now referred to as NCUA Payday Alternative Loan Program. I would like to introduce Cindy Johnson, our program officer with the National Credit Union's Office of Examination and Insurance, who will now provide more guidance on the actual payday alternative loan programs.
Thank you, Tom. And again, just to reiterate, if I talk about short-term small amount loans or payday alternative loans, I'm referring specifically to NCUA's program under 70121 C73, and that applies to federal credit unions only. So just to start out by giving a little background information about the Payday Alternative Loan Program, NCUA issued a regulatory alert informing federal credit unions that an amendment to Section 70121 of the Rules and Regulations, which authorized new guidelines for a short-term small amount loan program, would take effect on October 25, 2010. The regulation does not prohibit federal credit unions from offering other small dollar loan programs if the program provides loans in accordance with the interest rate ceiling of 18%, Regulation Z, and all other applicable laws and regulations. And I'll talk about some of those other programs at the end of my presentation. In order to offer a lower cost option to predatory payday lending programs, the Payday Alternative Loan Program permits federal credit unions to charge an interest rate of 1,000 basis points above the maximum interest rate established by the NCUA board if certain conditions are met. The current APR ceiling is 18%, meaning payday alternative loans may carry an APR of up to 28%. State-chartered credit unions are subject to the terms and conditions in their state's regulations. So again, I mentioned there are several conditions that need to be met in order to charge that interest rate above 18%. Some of the conditions include having a closed-end loan that fully amortizes by the end of the term. Loan principal cannot be less than $200 or more than $1,000. And maturity may range from 1 month to 6 months. Additionally, the federal credit union must establish a minimum length of membership requirement of at least 1 month. Requiring the borrower to be a member of the federal credit union for a minimum of a month before receiving a short-term small loan will reduce the risk of default. We encourage federal credit unions to evaluate their risk tolerance and set a membership requirement accordingly. So you can certainly decide to set a higher membership requirement than 1 month, but 1 month is the minimum amount of time. The federal credit union may charge an application fee to all members applying for a new loan that reflects the actual costs associated with processing the application, but in no case may the application fee exceed $20. Late fees are allowed under this program, but federal credit unions should establish the term and amount of a short-term small loan so that the member can pay back the loan without incurring late fees. The federal credit union must also include in its written lending policy a limit on the aggregate amount of payday alternative loans, up to a maximum of 20% of net worth. So again, you can set a lower limit, but the maximum limit that you can set is 20% of net worth. Continuing with program terms, the federal credit union cannot roll over any payday alternative loan. However, a loan's term may be extended up to the maximum 6-month term if the federal credit union does not charge any additional fees other than interest or extend any new credit. So for example, if a borrower took out a $300 loan for 3 months and at some point within those 3 months was unable to continue making payments, the federal credit union could extend the term for up to an additional 3 months, so up to that 6-month maximum term. But in doing so, the credit union could not extend any new credit or charge additional fees. A federal credit union may not make more than 1 payday alternative loan at a time to a borrower. In addition, a federal credit union cannot make more than 3 payday alternative loans to any one borrower in a rolling 6-month period. So whenever the applicant comes in, you need to look back at the previous 6 months to see how many payday alternative loans they've had in that time frame. So it's a rolling 6 months. The federal credit union must also establish appropriate underwriting standards in its written lending policies to minimize risk. For example, requiring a borrower to provide verification of employment by producing at least 2 recent pay stubs. If all of the conditions are met that we just talked about in the last few slides, federal credit unions may charge up to 28% on these loans. And just to touch on a few points under the application fee. The application fee can only be the amount needed to recoup actual costs associated with processing an application, up to a maximum of $20. You're not required to charge an application fee. Some credit unions don't, but the maximum you can charge is $20, and if the costs to process are lower than that, you must charge less than $20. So it just depends on the actual processing costs. If a federal credit union undertakes a more limited application process with repeat borrowers, there would be no justification for charging the same application fee each time the borrower applied. So again, if there's less time involved, less processing costs, the fee should be lower. By charging a fee to all applicants, whether or not credit is extended, and ensuring the fee only covers the cost to process the applications, the application fee is not considered part of the finance charge and is excluded from the APR calculation. Federal credit unions should evaluate member needs and the cost of processing applications in determining whether to impose an application fee and the amount of such fee. It is interest income and not the application fee that allows federal credit unions to offset the higher degree of risk inherent in these loans. In other words, the application fee cannot be used to offset potential loan losses or program risk. NCUA will scrutinize application fees to ensure federal credit unions are using the fee to recoup costs associated with processing an application and not to account for the riskier nature of this type of lending. So we've talked about the requirements under the regulation. Now to look at some benefits to members. The Payday Alternative Loan option will assist federal credit unions in meeting their mission to promote thrift and meet their members' credit needs. The major advantage for the member is that loan payments are spread over a period of up to 6 months instead of requiring the borrower to come up with the full loan amount within a very short time frame, often within 14 days. Sometimes the borrower will roll a traditional payday loan over, often multiple times. Under the requirements to amortize a loan, federal credit unions must structure the payments so that the borrower is paying a portion of the principal and interest in equal or near equal installments on a periodic basis over the course of the loan. Federal credit unions should offer payment schedules that allow borrowers to easily repay the loan within the given term. Members will benefit from smaller payments and partial principal reduction on each payment. And as we've discussed, the 20% APR limit and $20 maximum loan application fee are significantly lower than what borrowers pay for predatory payday lending products. And as we discussed also, federal credit unions offering this program may still charge late fees. So to take a look at an example of cost savings, the table on this slide shows examples of typical payday loans versus a payday alternative loan. So assuming a $250 payday loan that's rolled over for 6 months, which is shown in the middle column, total payments would equal $1,075. If the member borrows a $250 payday alternative loan for 6 months from their federal credit union, and that's shown in the right-hand column, total installment payments and fees would equal $290.81, saving the member just under $785. And again, that's just in a 6-month period, so that's quite significant for most people. Even a typical payday loan that's not rolled over, the member would still benefit from the reduced monthly payment of $45.13 for the payday alternative loan compared to $313.46 that would come due in 2 weeks, which is shown in the far left-hand column. In addition to the benefits to members, there are benefits to federal credit unions offering payday alternative loans. NCUA developed this program to enable federal credit unions to offer short-term, small-amount loans as a viable alternative to predatory payday loans, which often charge triple-digit APRs. Payday lending products are currently being used by your members elsewhere. According to the Pew Charitable Trusts, 12 million American adults use payday loans annually. On average, a borrower takes out 8 loans of $375 each per year and spends $520 on interest and fees. So in total, over the course of a year, consumers spend over $40 billion on payday loans and other small-dollar loan products, such as deposit advance, refund anticipation checks, pawn loans, auto title loans, and rent-to-own, just to name a few. As we've discussed, you may charge an application fee to cover the actual costs associated with processing an application, up to $20. The Payday Alternative Loan Program may be attractive to borrowers who value convenience and want a short-term loan only for a small amount. The program may even attract new members to your credit union. When compared to a loan charging an 18% APR, the additional 1,000 basis points in interest increases income for the credit union by $15.06 on a $500 loan, assuming, again, a 6-month loan. The monthly payment for the borrower would increase from $87.76 to $90.27. So the difference is not great per borrower, but on a pool of $100,000 in loans, assuming an average loan of $500 and timely repayments, the additional interest for the credit union would exceed $3,000 in 6 months. NCUA intends for this rule to help borrowers curtail the repetitive use of payday loans and transition them to more mainstream financial products and more responsible borrowing. Providing borrowers with sufficient access to credit will help them make this transition away from reliance on repetitive and high-cost borrowings. So in addition to the program requirements and the regulation also contains guidance and best practices to ensure a federal credit union's program remains viable and responsible. Some possible program features to consider include adding a savings component, providing financial education, such as a housing budget assistance or a budget workbook, reporting members' payments of payday alternative loans to credit bureaus, which will help them build a credit history, or electronic loan transactions. In terms of underwriting best practices, federal credit unions need to develop minimum underwriting standards that account for a member's need for quickly available funds while adhering to the principles of responsible lending. One goal of this program is to make it easy for members to apply so that federal credit unions can offer an alternative to payday loans. Underwriting standards should address required documentation for proof of employment or income, including at least 2 recent paycheck stubs. Federal credit unions should be able to use a borrower's proof of recurring income as the key criterion in developing standards for maturity links and loan amounts, so a borrower can manage repayment of the loan. For members with established accounts, federal credit unions should only need to review a member's account records and proof of recurring income or employment. And lastly, under best practices is risk avoidance. Federal credit unions need to consider risk avoidance strategies, including requiring members to participate in direct deposit and conducting a thorough evaluation of the credit union's resources and ability to engage in a payday alternative loan program. Under risk avoidance, we've got direct deposit and payroll deduction. NCUA believes a federal credit union is able to evaluate its risk tolerance and members' needs to determine whether or not to require members to participate in direct deposit in order to obtain a payday alternative loan. So again, this is a best practice. It's an option for you, but it's not a requirement under the regulation. As with any loan, you cannot make payroll deduction mandatory, and that's a Reg E issue. You can, however, offer an incentive, such as a lower rate, to entice the borrower to participate in payroll deduction. Other incentives could include free money orders or traveler's checks, or really any other offer you want to provide to encourage members to participate in payroll deduction or pre-authorized electronic funds transfers. I think the most common one is the lower interest rate, maybe 25 basis points is what I've commonly seen. Like direct deposit, NCUA believes payroll deduction is an important tool for federal credit unions to utilize in lowering the risk associated with payday alternative loans. However, it's up to each individual federal credit union to decide if they wish to provide an incentive to encourage members to utilize payroll deduction. So again, under Reg E, you can't require it. Our regulation doesn't require federal credit unions to offer an incentive for payroll deduction, but it is a best practice and something to consider as part of your program. Just a brief mention of Department of Defense regulations that Tom discussed earlier. NCUA notes the definition of a payday loan in the Department of Defense regulations would not include most short-term small amount loans made under the PAL rule. Under Military Lending Act rules, covered products such as payday loans may not have a military APR of more than 36%, and they may not automatically be refinanced by the lender. The next slide shows the definition of a payday loan under the Department of Defense. While all payday alternative loans will be closed-end and less than $2,000, and many will have maturities less than 91 days, the APR limit of 28% falls well under the military's 36% ceiling. Further, the NCUA rule does not require a federal credit union to obtain a check or payment instrument or authorization to debit a member's account concurrent with an extension of credit, nor does NCUA expect credit unions would generally need to do so. Therefore, a federal credit union will typically be able to offer loans under the terms of the PAL rule to members of the military without violating the DoD regulations. And Tom, I believe we have another poll question.
Yes, Cindy, thank you. In addition to that, for military reference, in the reference tab that Catherine mentioned earlier, there is a copy of the military lending checklist that examiners used in the ARES exam program. you'll find that very helpful in determining and supporting that your short-term program will be within compliance of DoD regulations. Now, our poll question for this is: Do you offer small dollar loan programs today? Answer yes if you do offer a program when maturity is less than 30 days. B is if you offer a small dollar loan program maturities greater than 30 days but less than 6 months and interest rates of less than 18%. C is we offer small dollar loans less than $1,000 of maturities less than 6 months and interest rates between 18 and 28%. And no, and D would be no if you do not offer the small dollar loans. And we use the E for if you're not representing a credit union today. We'll give you a few seconds for that.
Well, while we're waiting for you to answer those questions, please submit your questions now. You can submit them throughout the webinar. Thank you.
Okay, and the results are very small amount actually offer a typical payday type lending, less than 30 days, with 62% not offering small dollar lending today. Wow. I think we have some opportunities that you guys can look at in ways to really save your members possibly some money if you're looking into this program as a good alternative. And when we look at some of our current earnings in our own credit unions, it may be a very good way to also increase your bottom line. Okay, I'm going to return it back to Cindy for a few more topic discussion on the small dollar program.
Thank you, Tom. So again, everything else I talked about had to do with NCUA's regulation for payday alternative loans. Now we're going to look at some other small dollar loan programs. The Payday Alternative Loan Regulation does not prohibit federal credit unions from participating in a closed or open-end small dollar loan program that operates successfully and legally under NCUA's regulations and Regulation Z. So if you currently have an unsecured short-term loan program that charges 18% or less and it doesn't meet all the requirements we talked about earlier, that's fine. You don't need to stop that program. You just need to make sure you meet all the other lending regulations. This is just an alternative if you wish to charge a higher rate to take into account some of the additional risk. PAL program limitations only apply to short-term small amount loans where you exceed the 18% interest rate ceiling. So again, you are still able to offer other small dollar short-term and unsecured loans by charging 18% or less. Federal credit unions may participate in any program that provides loans in accordance with the interest rate ceiling, Regulation Z, all other applicable laws and regulations, and that operates within safety and soundness guidelines. Remember, the Payday Alternative Loan Program is currently only for federal credit unions. Again, it's 70121C73. So state-chartered credit unions must operate within the guidelines established by your state regulator. And one mention about funds that are available under the Dodd-Frank Act. The Dodd-Frank Wall Street Reform and Consumer Protection Act includes federal assistance to federally insured financial institutions that provide low-cost, small loans to consumers as an alternative to more costly payday loans. Institutions participating in programs under this section of the Act are required to promote and provide financial education and literacy to small loan borrowers. Community Development Financial Institutions, or CDFIs, may apply for grants from the Community Development Fund to develop and offer these loan programs. These grants enable CDFIs to establish a loan loss reserve to defray the cost of a small dollar loan program. In addition, technical assistance grants are available for technology, staff support, and other costs associated with establishing a small dollar loan program. So the requirements of NCUA's Payday Alternative Loan Rule will not prohibit a federal credit union, which otherwise is eligible, from receiving a grant or participating in a program under the Dodd-Frank Act. But that's not to say you have to have a payday alternative loan that meets all the requirements in the regulation. Again, you could have a short-term small unsecured loan program that charges 18% or less and still be eligible for some of these other programs.
Thank you, Cindy. I would now like to introduce you to District Examiner Carrie Donald from NCUA Region 3 to give you a perspective of what to expect from your examiner when they review this type of loan program.
Thanks, Tom. Now I'd like to answer the question most CEOs and managers ask: what will my examiner want to see? As a district examiner, we have the following expectations during an exam if you offer payday alternative loans to your membership. First, an adequate board-approved policy or procedures should accompany all products and services that a credit union offers to the membership. For payday alternative loans, examiners expect to review a policy that includes all of the requirements listed in Section 701.21 of NCUA Rules and Regulations. We will review your procedures to ensure proper underwriting standards are established and are being followed. Next, we normally request a sample of loan files to ensure all required documentation is collected from the member and that the loan terms are within the regulation. In addition, we will ensure that loans are being made in a way that provides the member with the best chance to successfully repay the loan. During our loan review, we will verify charged application fees are used only to recoup application processing costs and not to account for the riskier nature of this type of lending. The credit union's board of directors should establish a lending cap for the payday alternative loans program in relation to net worth. The regulation includes a maximum aggregate dollar limit of 20% of net worth. We recommend management and the board should determine an appropriate limit based on experience and available resources to manage, monitor, and track the portfolio. A few sample questions you can ask yourself to get ready for your next exam. Are you periodically evaluating the success of your program? Are you incurring unreasonable and unaffordable loan losses? Are loan losses exceeding your expectations or adversely affecting the credit union's net worth position? Answers to questions like these will assist in showing what modifications you may need to make to your program to secure the program's viability. So in conclusion, focus on your written policy and procedures, underwriting guidelines, program limitations, a proper fee structure, and monitoring techniques. In addition, examiners also follow guidance outlined in supervisory letters that identify the differences experienced in examining low-income and community development credit unions. We also use the actual regulations, Section 701.21, Regulatory Alert 10 RA 13, and Letter to Credit Unions 05 CU 01 to determine compliance with these programs. These references are also listed on slide 54 towards the end of the PowerPoint. Next, I would like to talk about the call report. NCUA also monitors the activity in this special program. We request that credit unions that grant payday alternative loans to report it properly on the call report. The call report instructions use the term short-term small amount loans, or STS loans, interchangeably with payday alternative loans, or PALs. These loans are reported on pages 2, 7, and 9. Remember, though, that only federally chartered credit unions are allowed to offer the payday alternative loans with a 28% APR. These loans will be reported in the STS loan categories. For state-chartered credit unions that offer a similar loan product should report the balances in all other unsecured loans and lines of credit categories. Going to page 7 and 9, for federal chartered credit unions, you will report the number and dollar amount of delinquent payday alternative loans by the appropriate number of days delinquent in the STS loan category. On page 9, you will report the dollar amount of payday alternative loans charged off and recovered year to date. For state-chartered credit unions, for your similar loan products on page 7 and 9, you will report all the loan balances in the all other loan category. Also, please note that if you do offer the Payday Alternative Loans product, you should log on to your CU online profile and mark short-term small amount loans on the Program and Services tab.
Thank you, Carrie. Cindy, I have one question for E&A. If a federal credit union offers a small loan program but has kept the interest rate under 18%, do we want them to report this on the call report in the special areas of the STS loans?
We do not at this time. We want them only to report the loans that are over 18% and meet all the other requirements of the short-term small amount loan program.
Okay, thank you. Okay, getting started. Let's quickly just summarize a little bit, is to make sure that when you're establishing and implementing a program, whether state or federal, please ensure the board approves a sound, safe policy establishing all the terms and conditions. You need to really evaluate the potential impact that can have on both you and your members, positively and negatively in meeting your, and also positively and negatively in how it meets your business plan. Okay. The risk avoidance side is think about how you can maximize the opportunity to receive your payments on a timely basis. We encourage payroll deductions as one of the best alternatives to keep the cash flow coming in. Establish a sound collection program when developing the program. And monitor your results on a regular basis. One thing that you need to do, or should do, is be able to report to the board of directors how many loans you've made in a year, how many loans have, what the total balance of loans made, what your delinquency experience has been, and your charge-offs. You want to be able to evaluate whether the program is successful or not. I would also encourage you to do it since inception to be able to show your members how much you've been able to save them over the life expectancy of the program. I'd like to now introduce the three CEOs that are going to give us their perspectives. In other words, we're mentioning the program, they're living the program. We'll start first with Jennifer Lovett from Mississippi DHS. Jennifer, will you please give us a little bit of background on your credit union and the small dollar loan program?
Thanks, Tom. We're a $7.7 million federal credit union serving a single seg group. Our net worth's around 15.5% of assets. We offer no credit checks, $750 6-month loan at 28% interest with a $20 non-refundable application fee. The borrower must be a member for at least 60 days prior to the loan application. They must provide proof that they've been employed for at least 6 months. And we also require that 10% of the loan proceeds be put on reserve until the loan is paid in full. We report the payment practices monthly to the Credit Bureau to give the members positive credit information for paying their loans timely. And, of course, if delinquent, that's reported as well.
Will you please tell us how your application underwriting procedures work and like who qualifies for the loans and what records they submit?
The application must be completely filled out and signed. Before we process the loan application, we run their Social Security number through PACER. That's the online bankruptcy database. If we determine that they're currently in bankruptcy, we deny the application until the bankruptcy is discharged or they have their trustees send us a motion to incur debt. Anyone who's been a member for 60 days with at least 6 months of employment qualifies.
Did you establish a collection program along with this program?
We use the same collection program as with any of our other loans. As they become delinquent, we move a little bit faster on the court judgment process, considering that the loan terms on this loan is only 6 months.
Are you currently offering your members any financial counseling?
Currently, we're not offering any formal financial counseling, just your general sit down and talk if we feel that it's necessary, but no formal counseling.
Now, what does your board think of the program?
The board understands that it produces a considerable amount of income, and they also understand as well that the income from this loan outweighs the risk attached to it.
What do your members think of the program?
They love it.
And what about your examiners? Have they made any exception to the program?
They've never had any exceptions other than that it's performing well with our membership.
Okay. So would you say you have a successful program?
Yes, I would say I have a successful program. At the end of 2013, we did 1,160 loans to our members. Our loan balance, our loan total at the end of December was 585 loans for a total balance of $262,500. We run about a 4% delinquency rate with this program, but at the end of December, we only had 10 delinquent loans at a total of $2,764, which was only 1% delinquency. Our net charge-offs for 2013 was $6,805. We consider this low for the product based on the income that was earned. And our net yield after charge-offs is about $80,000 for 2013.
Has it helped you make more loans to the members?
We've been able to do signature loans, special loans like back-to-school and Christmas loans. We have cross-sells on some car loans as well, but usually we're just meeting an immediate need.
Okay. But if you don't get a credit report, how do you know if they need these other products, the other loans?
Well, we like to know our member. We like to know what they need and what they want. So during the application process, we're asking questions, just trying to get an idea, establishing a relationship.
So the interview process is very important.
Yes, very.
Okay. And has these members offered you any referrals of new members or family members?
Absolutely.
Okay. And did you experience any problems along the way in developing the program?
Yes. When I was hired with the credit union, this particular product had been suspended. And when I started, 90% of our call volume was asking when they were going to reinstate the loan. My only advice would be don't ever stop and start this loan. It created chaos with our credit union. Once I reinstated the loan, we booked 500 loans in 2 months, and I have one loan officer. So that ought to tell you something. And I would highly encourage the 10% reserve after doing a little research on charge-offs. That 10% helps in recovering some delinquencies.
Okay. One final question. What advice would you give someone considering the program or not?
The main advice is to know your member, know their needs and their wants. You can tell a lot about someone by just evaluating their checking account history, and especially if they've fallen prey to payday lenders. It's very apparent with their checking account. And keep in mind, this is a no-credit check loan, so you definitely need to have a backup plan as far as getting your log-on information for Pacer so you can run to see if they're in bankruptcy. We've been caught in a trap to where we weren't running Pacers, and members were currently in Chapter 13 bankruptcies, and we gave them a loan, didn't know it, and the trustee found out, and we had to send them all the money back, and then we had to charge off the total loan balance. So if you have the ability to get payroll deduction, encourage your member to do so. You can't require them, but you can definitely encourage them as a convenience. And if you originate ACH, definitely encourage bank drafts as a convenience. That's the main thing.
All right. Thank you, Jennifer. One last point I want to also bring to your attention. Jennifer has agreed to give you her email address in the event you have any questions for her after the presentation. She can be reached at Jennifer Lovett, Lovett, at Mississippi DHS Federal Credit Union, and her email is jlovett@eplinc.com. Correct, Jen?
That's correct. Thanks, Tom.
All right. Thank you for your help. And I now would like to turn it over to Carrie, who's going to introduce the next CEO.
Thanks, Tom. Now I'd like to introduce to you Vicki Hastings, CEO of Greenwood Municipal Federal Credit Union. Vicki, could you please tell us a little bit about your credit union?
Sure. We are approximately $34.9 million in assets, and we're located in Greenwood, South Carolina. Our field of membership is a multiple common bond, primarily in federal, state, and local government.
Will you please describe your small dollar loan program?
I will. Carrie, we call our short-term loan program the Cash in a Flash. It's a personal loan, and we offer the program to our membership as an option to the Payday and cash advance lending. Our program includes the requirements that are listed in NCUA Rules and Regs, Section 701.21. However, the restrictions are slightly different. Our maximum loan is $500. To receive the maximum of $500, a member must have 2 years of continuous employment with current or last employer. If an employee has only 1 year of continuous employment, the maximum loan amount is $300. The minimum loan amount remains at $200 per the regulation. Our APR is 28%, and we offer this loan up to 6 months. Additional restrictions that the Board of Directors have placed on the program: applicants must use and must have and use one additional service other than our regular savings account. Direct deposit or payroll deduction is strongly encouraged. And as Jennifer said, it's not required, but it is encouraged. After the loan is paid, another loan cannot be granted for 90 days after the previous loan has been paid in full. And all accounts with Greenwood Municipal must be in good standing for 90 days.
How do you feel that your program is performing?
I feel like it's doing very well. At the end of December, we had on our books at that time about 460 loans with total outstanding balances of $143,964. We had granted a total of 452 loans with outstanding balances of $137,638 by the end of this March. And our charge-offs for last year on this particular loan have been for 2013, $5,295, 2012, $4,575.
So, Vicki, do you normally deny any loan applicants?
We do, because, and that just comes under our policy with them having another service. If it's not in good standings, if they have a checking account that has a negative balance, or they've had more than 3 NSFs in the past 90 days, we do deny them the loan, and we do try to counsel them on how to maintain a positive account.
Okay. I'm sure there are many credit union managers listening that would like to start this type of program. What advice would you give to other credit union managers before starting a program like this?
Probably the biggest advice, or the biggest piece of advice, would just to move slow into the program. Determine what works for the individual credit union, because needs are very different. Make changes as needed. If you develop a policy and you see that something's not working, then tweak your policy a little bit. And always, and this is what we do, is to use this loan as an opportunity to offer other services or loans. What we found that members that are obtaining these loans are not always high risk. They just want the convenience of quick money.
That sounds like good advice. To everyone listening, previously Vicki agreed to assist listeners with the program or possibly policy questions. She agreed to give you her email address. That's going to be vhastings, which is VHASTINGS @gm-fcu.org. Thank you, Vicki.
You're welcome.
Now we have Katia Nunez, the CEO of St. Francis Federal Credit Union, to tell us about their program. Katia, will you first give us some background information on your credit union?
Sure, Carrie. Thank you. We are approximately $7.5 million in assets, and we are located in Greenville, South Carolina. Our field of membership is a multiple common bond, primarily in healthcare. We implemented our short-term small loan program in November 2012, and we call the loans under this program STS Quick Cash.
Can you speak up just a little bit because your volume is kind of low, please?
Sure. Sorry. Do I need to repeat it?
Yes, please.
Sure. We are approximately $7.5 million in assets and are located in Greenville, South Carolina. Our field of membership is a multiple common bond, primarily in healthcare. We implemented our short-term small loan program in November 2012, and we call the loans under this program STS Quick Cash.
So can you explain your STS Quick Cash loan product?
Yes, Gary. Our program follows all the requirements set by NCUA Rules and Regulations Section 70121. We also implemented the recommended best practices under the regulation, which is require from applicants a proof of income, encourage payroll deduction by offering a 3% rate deduction for those that do sign up for payroll deduction, provide financial education to the applicant, and require a saving component. And the way the saving component works is by setting up a sub-account in which funds are held until the loan is paid in full. And after that, the member can receive that funds. And that is to teach them that savings a little every pay period or every month, it does add up at the end. And it can help them get out of that cycle of always borrowing to make it to the next paycheck. In the event of a charge-off or delinquency, beyond the 30 days, we use the funds held in that account to be applied toward the loan to reduce our losses. The saving component is equal to 50% of the payment. So, for example, a $500 loan with a 6-month term and a 25% APR will require a payment of $90. In addition, we require an additional $45 for the savings component for a monthly payment of $135. At the end of the repayment period, the member will have $270. Our members seem to love it. Some of them even forget the savings component, so they are very happy when we tell them they have money available. And in some instances, our members have decided to leave the money in the savings for rainy days. So that has encouraged better saving habits. Also, the board has required additional sets of requirements such as steady employment for at least 6 months with the current employer or within the same industry, 2 references which must be obtained and verified prior to the loan approval, a maximum loan amount not to exceed 50% of the applicant monthly gross income. We don't do any loan advances or extension. We don't pull a credit report, but we do report their repayment history to the credit bureau, and we require them to don't advance or don't request another loan within 30 days. So they have to wait at least 30 days before they can ask another short-term loan.
Okay, so do you feel that your program is successful?
Yes, we started with virtually no advertisement because we wanted to be cautious about it. But since inception, which was late in November 2012, through the end of last year, December 31st, 2013, we granted 98 loans with a total balance of $53,159. We only charged off one of these loans for $385, and we made a profit only in income, that doesn't include the fee, of $2,200. Now that our cautious phase is over, the board feels comfortable to move forward, and we will start promoting this program as a way to avoid or stop payday lending and loan sharks from taking advantage of our members.
So, Katya, do you have any advice for other credit unions that may want to implement a similar loan product?
Sure. My advice is to really understand the needs and wants of your membership and create a product that meets your member where they are, but also is designed to educate them and promote healthier financial habits, such as assisting members with budgeting and showing them the value of continuous savings. I report to my board monthly the performance on this particular loan product in itself, and in specific, the net yield is very important. Like I say, fortunately, we didn't have a lot of losses, but they can adapt quickly and make the program not worth having if you don't keep an eye on it. So I strongly suggest keeping a close eye, at least monthly, on this particular program. And for us at St. Francis, the key is to never say no. So as long as the applicant is within the guidelines that we set up and they didn't cause a loss to the credit union, we will always grant a loan, this kind of loan, the SDS. And I have a success story that is my favorite one about a member that came in expecting to get the full $1,000 the first time he borrowed or he requested to borrow. And that was because his coworker told him that they were able to receive that much without a credit check. So we explained to the member that the requirements involved with being qualified for the loan, and then the fact that since he never borrowed from us before, we wouldn't be able to start with $1,000. We will start with a lower amount, and then as he paid back and do other loan in the future, we could build up to the $1,000 so that he can build a relationship with us. And initially, he was very resistant to the idea, and each time his payment was due, he would try not to pay the savings component. But then with much counseling, he finally learned the value of the program. Unfortunately, what happened to him is he lost his job and a couple of months ago, and he became 30-day past due. However, he called us 2 weeks ago and said that he found another job, that he wants to start direct deposit, and since then he has started direct deposit, and his comment was, "You guys have been so good to me, I want to be good to you." So that experience in itself for me is worth more than the interest income that we are earning in these programs. Knowing that we're living the credit union mission of people helping people is my greatest reward. But don't get me wrong, the income is good too. So, and then also we use this particular program to identify members that feel like their credit is so bad that they will never get a car loan or they will never get a good rate on a car loan. And so my favorite story on this one, or my brag story, is this one member that we were able to take out from a title financing company with a 300% APR, bring the loan over to us for an 18% APR. We cut his payment in less than half and his repayment time in less than half. So he was thrilled. We were thrilled to be able to help him. And the philosophy is that if a person has made at least 6 consecutive on-time payments to a company that charges high interest and the payment is often higher than what our payment would be, then there shouldn't be any problem for that member to be able to pay our smaller payment. And then when we mention payroll deduction, and they don't have to worry about making the payment because it will happen on its own, they like it even better.
That's 2 great examples. Thank you, Katya. I bet members love the feeling of paying a loan off and then having money in a savings account.
Yes, they really love that.
Katya also agreed to help those who are listening today. You can reach her at her email address. It's KATIA_NUNEZ@bshsi.org for for any other questions. Thank you, Katya.
You're welcome.
Thank you, Carrie. And it's also important to recognize that NCUA's small dollar loan program is not the only programs out there. Please refer to your league affiliates, your CUNA associations, your NAFCU, and your other organizations that you may be members of to get additional information, as well as your state regulator themselves. I also want to just remind you of the reference tab once again. On the blue tab, it's a number of the documents we use to present this presentation. I also want to emphasize in there is a reference to a guide to small dollar credit lending by the Center for Financial Service Innovation. It was just completed in March of 2014. It gives a good reference in how to evaluate what a high-quality small dollar loan would be. And wrap up, our goal is to identify ways to help you save your members money and build relationships with new members. The PAL programs, or short-term small dollar lending programs, offered can give the members a more affordable loan option as compared to going to the retail predatory payday type lenders. We'd like you to reach out to your members by offering a quick convenience of the loan products and educate your members about different loan options to decrease the interest rates they may have to pay with the other lenders and benefit from you. And now I would like to turn it over to Diane Rector, Supervisory Manager of the Office of Small Credit Initiatives.
Thanks, Tom. We're getting ready to open up the floor for questions for our audience. But before we do that, I want to let you know about some upcoming events. Mark your calendars. On May 21st at 2 p.m. Eastern Time, we're going to have a webinar with how to be in compliance with OFAC and FinCEN. OFAC and FinCEN will be our guest speakers as a part 1. And after that, you'll be able to answer poll questions and answer approximately 12 to 15 questions for a certificate like we did with the BSA last month. Again, on June 11th at 2 p.m., we're going to have cybersecurity awareness. On June 25th at 2 p.m., we're going to have part 2, how to be in compliance with OFAC and FinCEN. We also have some training events coming up. Mark your calendars. June the 7th, we're going to have a leadership boot camp in Baton Rouge, Louisiana, and in Los Angeles, California. We're pushing out the survey to you now.
Okay, and we're going to begin our Q&A. We had some question and answers that came in earlier. So what we're going to do, we're going to entertain those for our panel. And so the first question that we're going to ask, one second. The first question we're going to ask has to do with, here we go. This comes from a board member from a small credit union, and they do small dollar lending for equipment, such as riding lawnmowers, garden tractors, and so forth. And they want to know how these items can be secured as collateral without a title, like with vehicles. So they're looking for ways to provide a lower interest to their members without unsecured loans. So who would like to answer that question?
I can, Jennifer from Mississippi DHS Federal Credit Union. In my experience with like tractors and lawnmowers and things of such, I know here in the state of Mississippi you can file a UCC code on those types of equipment.
Okay, fantastic. We have another question that came in This has to do with the fees associated with the loans. Normally, interest is how we would generate income, the credit union says. Is it compliant to charge a flat fee? And they gave an example. They said, for example, $20 per thousand. Who would like to answer that question?
I can, Catherine. Again, for the Payday Alternative Loan Program, well, and actually all loans under Reg Z, it's really based on your loan processing costs. So if you could show that there are higher processing costs associated with a higher dollar volume loan, you might be able to implement something like that. But it's really based on the cost of processing the application.
Thank you, Cindy.
In addition, though, that would only be in addition to that, though, that would only be if it's not the Payday small dollar loan program, because that program has a $20 limitation. So if it's a longer-term loan or one following the 18% interest rate limitations and a normal consumer-type loan, that would be permissible as long as you support the costs.
Thank you, Tom. Question 20 is going to go to Katia. So question 20 says, what do you mean by adding a savings component?
Sure. As I explained, that we open a special suffixed account to where the member that receives the loan doesn't have access to, but every time their payment is due, they have to make their normal loan payment plus 50% of that payment, and the additional savings payment component will be put in the special savings on hold. Once the loan is completely paid in full, the member will have access to that savings. And basically it's to try to explain to people that if you save a little every pay period or every month, you don't realize how quick it adds up. And after the 6 months, like in the example I gave, if the payment is $90 a month and they pay an additional $45, they will have $270 saved within the 6 months. So in a year is $520. They can have a nice Christmas, or they can pay a bill that was unexpected, car taxes. So it's to show them, to teach them that habit of save a little every time you get paid.
Thanks, Katia.
You're
The
welcome.
next question, number 36, goes to you. If we start a Payday Loan Alternative Program and elect to charge a $20 application fee, would we also charge an application fee for, say, auto loans, or could we just limit the fees to just Payday Loan Alternative Loans?
Here in St. Francis, we only charge for the short-term small loans. That's the only loan that gets the fee, is a flat 20, no matter the amount requested, and it has to be charged up front because we cannot charge it only if somebody gets approved, so otherwise it becomes actually part of the APR calculation. So when somebody decides to apply for that kind of loan, we let them know this type of loan, there's no credit check, but you do have to pay the $20, and if you don't get it for whatever reason, you don't get the $20 back. But I mean, there's nothing that says that you cannot charge another loan, like auto loans or anything. We just never have in the past, so we decided to limit the fee just for this particular product because of the cost of making the loan and preparing the paperwork and everything versus the longevity of the loan.
Okay, thank you, Katia. The next question is going to be question number 15, and that's going to go to Diane Rector. Here's the question. Are all the loans called Payday Alternatives? Can they be called small dollar loans? That's part of the question. The second part of the question says, if the repayment is up to 6 months, then it really isn't tied to a paycheck, as the name implies. The name has negative connotations in the marketplace.
Thanks, Catherine. PALS, P-A-L-S, is the name NCUA uses for the loans written under its regulation. This regulation also has been called STS. The regulation encouraged federal credit unions to compete with payday lenders without exposing their members to predatory practices. For an example, the 2-week term and frequent rollovers of payday loans lead to excessive charges. Thank you.
Okay, thank you, Diane. The next question is going to go to Cindy. Cindy, this is question number 68. Here it is. Are there any laws that prevent payroll deduction? That's part one. I have a small dollar loan in my incubator that partners credit unions with employers. We highly encourage payroll deduction. Some credit unions think that it is not legal to do that. They say it cannot.
As I discussed, so requiring payroll deduction as part of the extension of credit is not allowed under Regulation E. But you can provide incentives for payroll deduction. So again, you could give a lower loan rate, you could provide free services that otherwise the credit union charges for, things like that to encourage payroll deduction, but it cannot be required under Reg E.
All right, thank you, Cindy. The next question goes to Katia, 67. Question is, do you pull credit reports at all for PAL loans?
We don't. We feel that most of the people that will request that type of loan will probably have pretty bad credit to begin with. So to prevent us from being judgmental in any kind of way, because that's not the whole point of, it's not the point of credit union period, but it's definitely not the point of that particular program. It's much easier to stick to the guidelines that the board and the regulation stipulates and just be fair to everybody and don't get any tainted or any temptation to do anything because we saw that credit. But on the other hand, we do report as they pay every month, which helps them to get a credit score if they didn't have one or improve their credit score if they had a bad one. And then we talk to them about, okay, we're not pulling credit report for this loan, but if you have a vehicle that you've been paying on or anything, you know, you can apply for a car and we'll help you. So we try to let them know that even though they may feel they have bad credit, that may not necessarily be a reason for us to turn it down a different kind of loan. So we try to help them.
Number 16 goes to Cindy. When you refer to rollover, do you mean that if a member wants to get a new loan nearing the end of the loan, the first loan have to be closed out and start a new loan?
So the prohibition against rollovers really relates to situations where the borrower is charged an additional fee for extending or reborrowing funds to avoid delinquency. So in the situation described, yes, the member really needs to pay off the existing loan before a new loan begins, unless you're just extending the term up to 6 months. But you also need to consider the prohibition or the limitation against more than 3 payday alternative loans in a 6-month period. So if you're closing one out and reopening another one, you do need to look back at the rolling 6-month period as well.
Okay, thank you, Cindy. We have a question for Jennifer. She was feeling kind of lonely. So we have a question for you, Jennifer. Question number 21, and here's the question. It says, most credit unions make some loans already to members with marginal credit. What is a best practice to differentiate between members who would qualify for conventional loans versus PAL loans?
Well, I think you have to take the component of the qualifying for conventional loan out of the question, because predatory lending loan, which it's not predatory lending, but our no credit check loan is a no credit check loan, and our members are getting these loans because essentially they're embarrassed of what their credit looks like, and they don't even have any clue of what it looks like. They just think that their credit is bad, so they have to get a no credit check loan. But necessarily, I think that's where the relationship comes in. You need to have that relationship with your member. You need to ask questions when they think they need a no credit check, a small no credit check loan over a conventional loan. And, you know, I would encourage financial counseling or set up things like I've set up soft pulls for credit reports. In the event a member is too terrified to get a loan, we can evaluate their credit without them getting a negative hit against them through the credit report pull. But I don't really think, we're credit unions. We don't need to differentiate between conventional and no credit check loans. we should want our member to be able to get all loans. And I think that that loan is a stepping block to bigger and better things for them.
Thank you. Vicki, can the borrower be required, number 13, can the borrower be required to pay the application fee prior to the application being processed and a decision made with to approve or decline?
Well, we do not charge an application fee, but if I remember the regulation, if you charge at all, then it needs to be charged whether they're denied or approved.
That's correct, Vicki. That's the advantage or the purpose of the regulation for this program, too, is as long as you charge the application fee to all members, okay, it is not considered part of the finance charge when you're doing your APR.
Mm-hmm. We just haven't implemented an application fee.
Okay. For all of our speakers, while you're online, please don't answer the questions online. We're going to entertain the questions live. So we have, Diane is going to ask question number 113.
113. Are any of the credit unions in the presentation charging the application fee? If so, what are you charging, and how do you determine the cost to process your short-term loan program?
I can answer that if you want me to. This is Katia from St. Francis. We charge a $20 fee, and the way we calculated that cost, of course, that's the maximum that is allowed, but the way we calculated that cost is we pay our loan officers plus the paperwork, and we call members and everything. So it takes about maybe an hour and a half to process one. So the $20 is fair between, like I said, the paperwork required and the time. So it will be the wage for that particular loan officer to run the loan.
All right. The next question is question number 18. It goes to Cindy. Cindy, here's a question. If a member gets a new loan immediately after the first loan is paid, can we charge the associated fees again?
Well, again, there's a few considerations for this. If you're doing less application processing for repeat borrowers because you've already gathered some of that information previously, the fee really should be lower. So yes, you could charge a fee, but it might need to be a lower fee. If you're doing the same processing for everybody, no matter how many times they've had Payday alternative loans with you, then you could charge the same application fee.
Okay, stay on the line, Cindy. We have another question for you. Question number 25. Requiring direct deposit is not a Reg E issue, is a question, I believe, or is it?
Requiring payroll deduction is not allowed under Reg E. Requiring direct deposit is not a Reg E issue. That's up to the individual credit unions to decide if they want to require that. So the difference is direct deposit, the person's check is coming right into the credit union. They're not getting a paper check in the mail, and you're not taking those funds and applying them to the loan. That's payroll deduction. So direct deposit is just the person's check coming in, and that can be required as part of the loan. But it's not a requirement under our regulation. It's an option for the credit union.
Okay. Diane, go ahead.
118?
Yes. The next question is going to be for all of our speakers. It's question number 118, and here's how the question reads, as soon as I find it.
What APR did each of the credit unions charge on these loans, the three speakers that we have online?
This is Jennifer Levitt at Mississippi DHS Federal Credit Union. I charge 28%, which is the max that's allowed by NCUA.
And this is Katia at St. Francis. We charge 28 without payroll deduction and 25 if they sign up for payroll deduction as an incentive.
This is Vicki with Greenwood Municipal, and we charge 28%.
Okay, thank you. We're going to entertain one more question, and that question is for all of our speakers. Question number 35. Does anyone look at debt ratios?
I can answer that. This is Kathy at St. Francis. We don't look at debt to income ratio. The only thing that we look is the gross monthly earnings, so that we can determine not to give them more than 50%. So if somebody makes $1,500 gross a month, the most we will lend them is $750. But we don't do the debt to income.
This is Jennifer at Mississippi DHS Federal Credit Union. The only time that we look at debt to income ratio is when a member applies for more than one loan. Like if they apply for our signature loan and the 750 loan, well, we call it a 750 loan here, the no credit check loan, we'll process the signature loan because we get to pull a credit report and evaluate their debt to income then. And if their debt to income doesn't follow our guidelines, then we will decline them for the no credit check loan. That's the only time that we do that.
This is Vicki at Greenwood Municipal, and we do not look at debt to income.
Great. We're going to wrap this up with, in 1 minute or less, can each of the speakers tell us how do you market the program? You'll market your program, starting with Mississippi DHS Federal Credit Union.
Our market is word of mouth and in our quarterly newsletter.
Thank you. Next.
I can answer if you want to, Katia from St. Francis. We did no marketing. It was all word of mouth. But this year, we will begin putting in our quarterly newsletter an article explaining what predatory lending is, what payday lending is, how costly it can be, how you don't realize what you sign up for a lot of time, and what we offer to help them.
This is Vicki at Greenwood Municipal, and our marketing is word of mouth. We have not advertised in any other way.
Okay. Thank you, guests. Before we end the call, several individuals asked for us to repeat the email addresses, and I'm getting ready to do that right now. If you have your pen and pencil ready. For Jennifer Lovett, it's JLOVETT@EPLINC.com. That's Jennifer's. Vicky's VHAS@GM_FCU.org. It's either dash or underscore.
It is a
dash. It's dash for Vicki. Katia, it's KATIA_NUNEZ@BSHSI.org.
And that will wrap it up for this afternoon. We thank all of our speakers and our invited audience. And don't forget to join us next month, May the 21st, for our webinar with OFAC and FinCEN. Until then, at 2 o'clock. Don't forget, it's 2 o'clock Eastern. Until then, we'll see you later. Have a great afternoon.